Well, holy smokes, everybody. A new bearish bad sign has just come out for the S&P 500. Even if we get 1 or 2 bad days of a 0.5 or 1% drop, the dip buys come in, they scoop up the dip.
Here we go, come on, push it, buy the dip, buy the dip.
And it keeps climbing higher. But something that has been contributing to this huge stock market rally is debt. What you have to know is the S&P 500, the stock market, all the money in there, and the reason why the stock market is so high, it's not all cash. A lot of it is margin debt, people just taking out normal debt to buy stocks, and also derivatives and futures contracts, etc. So when these derivatives or leverage falls in the stock market, this means investors are worried, and this means a peak may be very close. So let's not waste any time, everybody. Let's get straight into the news, the facts, the data right now. So looky here, everybody. Investors are borrowing less to buy stocks, and that could be a bad sign. The S&P 500 has continued its upward climb in recent months despite rising fears about the Delta variant and tapering. But one indicator may be a warning of a weaker or even bearish period ahead for stocks. So that's right, we've got the risk of surging cases in the US to weaken the economy, but it seems like there aren't going to be any lockdowns, which is good for the economy and good for stocks. And we've also got this risk of tapering, which the Federal Reserve said it's going to do this year, but even that doesn't seem to be enough to make the stock market worry. But now we've got another risk. Margin debt, which is money investors borrow from brokers to buy securities. This hit a record high in June, and this is something I've been talking about on the channel, at 882 billion per FINRA, and has since slumped. So July marked the first time margin debt declined since the pre-COVID days, and that decline comes at a time when the S&P is hitting all-time highs. So what that simply means is investors don't think the returns are going to be higher than interest they're paying, or they may think a decline is coming and they want to be able to hold their margin debt or hold their leverage there. So when a big dip does come, like what happened in March 2020, well then they can go ahead and buy up stocks for a big discount on margin. And I'll bring up a chart here, everybody. We can see here that margin debt goes up along with the S&P 500. So the red line here is margin debt and the blue line is the S&P 500. And what do we see here? In 2000, when margin debt peaked, we saw a big crash in the stock market. Again, in 2007, another big crash. Again, in 2018, when margin debt fell, we saw a big dip. And now it is peaking and falling in 2021. What do you think is going to follow when we look at the historic data? And listen to this, everyone. This is very important to know. Although peaks in margin debt don't always coincide with highs for the S&P 500, they tend to be bearish for equities. So 21 times since 1997 based on FINRA data. So when margin debt peaked, S&P 500 performance ensued. So if June 2021 proves to be another cycle high for FINRA margin debt, the risk is for weaker and in most cases negative S&P 500 returns from 1 month through to 24 months after margin debt peak. Well, holy smokes, everyone, this is huge. What this indicator is saying is normally the month after it peaks and also for the next 24 months, we have negative S&P 500 returns. Now, right now, that just seems impossible, especially with, the money printer go burr and the Federal Reserve, always being on the market side. So people, what you have to know is these crazy stock market returns that we're seeing are unprecedented. Never have we had a 13-year bull run. And though that it seems great and these returns are awesome, remember, the higher the peak and the steeper the peak, the quicker and deeper is the decline. So Satmir says, to put numbers on that, he notes that 1 year after a peak in margin debt shows the S&P 500 down 71% of the time with an average return of minus 7.8 to 10%. So this means if we were betting, the odds are in our favor. There's a 70% chance that we're going to see at least a 10% reduction in stocks, which, for the past year, it seems like every time there's a dip, the Federal Reserve looks at the dip and boom, 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 shoots that money printer and gets those stocks back up. But now with the Federal Reserve saying they will taper and with soaring inflation, they're not going to be able to use that tool this time. So Federic suggests that the July drop in margin debt is unusual, and it is unusual, since historically margin debt goes up when the stock market is going up and goes down when stocks sell off. We haven't really seen a big downturn in the market, and we really haven't seen a big drop in margin debt since March 2020. So could this be the hedge funds deleveraging? Because remember, a lot of the margin debt is done by hedge funds. Could they be seeing something that the retail investors don't know about? So that's why the July data is very unusual, because the market is essentially sitting at all-time highs when we had a pretty sizable downtick in margin debt. That's really weird, he says. Certainly there are other factors in play in terms of how investors are feeling about stocks, and the S&P 500 may perform in the short term, including seasonality. August and September tend to be weaker months for stocks. So could we see, if margin debt continues to decline in September, we'll have to watch and wait for the data. Could we see a downtrend in September next month? Well, I think if the Federal Reserve does announce in the minutes that they are going to be tapering, not talk about tapering, and with declining margin debt, and just with valuations being so high, they've really never been this high since 2000 and 2008. Even though it seems like, a stock market crash is impossible and it's never going to happen, or people say, look, they've been calling, a market crash for 10 years now, it just means we're getting closer and closer to the inevitable. And you may think, oh, this is all doom and gloom and bearish, but people, when we do get a good reduction in the stock market and when things do get to good fundamental values, I'll be in there buying the dip, the real dip, and I'll be letting you all know, and I'll turn from bearish to bullish. So everyone, that was just a quick update with what's happening with the signals in the stock market. Let me know if you like these shorter, more frequent updates, or if you'd like less frequent, longer videos. I'm trying to give you guys the data and the information as quick as possible so you can make the best informed decisions for your own personal situation. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you updated with the latest happening in the stock market, the housing market, and global finance news. Now, if you're bored, I'll put up some other videos here. I'll see you all there.